then they'll just no,
the slide doesn't work.
Oh, they don't have it on this one. So let's do that.
Yeah. Alright, so guys, we have an announcement to make. So Ryan and I are actually very good buddies with the President Ron and Dean Hush and Provost McClellan and all that. We're very connected. So we've sort of arranged a deal. Everyone in this class gets an A+ in their transcript, 4.33. So how do you guys feel about that? You seem very happy. Sorry, what is your name again? Rachel, you seem very happy. Why does that make you happy?
That would be awesome.
That would be awesome, right? Does anyone think that wouldn't be awesome?
I just want to get into class.
We could do that. We could just be A+ to keep it cheap.
Sort of like compromise solution for you. Yeah. All right. So you guys seem pretty happy. So would you be as happy if, as part of the deal, we didn't just give all of you guys an A+, we gave everyone on campus an A+. So whether you registered, not registered, every undergrad at Rice got an A+. How do you guys feel about that?
Pretty good.
So pretty good.
Is there anyone who does not feel as good now? Yes.
Yeah.
Say why? Wait, tell me your name again, please.
Catherine.
Catherine.
Because the value of the A+ goes down because everyone has one, so it's not really special anymore.
Ah, very good insight.
That's an interesting concept. So what you're saying is it's a relative value, right? Okay.
So let's bring it now to something that's more relevant to the class, policy-wise. So let's talk about money, right? So what if I had this helicopter, right, and I could just fly over your house, right, and drop like $1,000 on your lawn? Right?
That would be pretty bad.
That'd be pretty bad or good?
Because all the neighbors would rush over to my house.
What if
Well,
it's
your
like-
backyard.
Yeah, your backyard. It's like incognito, like no one knows that it's there, right?
They'll dig a hole.
Right? But now, comparatively, what if we drop $1,000 on every single person in the United States lawn?
Absolutely.
Sure.
So we have Pete Scatter. Does anyone want to sort of volunteer with a thoughts on that? Zero. Yeah.
I mean, yeah, I guess it would be devalued a little bit, but it would still be pretty legit.
But the point is, there is some essence of this devalue, right? So if you had a choice, you would sort of be selfish and take the $1,000 on your end or the A+ on your end rather than spreading it out to everyone, right? So Catherine, you touched on this earlier with the grades. You know what people call that when? So for example, Harvard's average grade is like 3.6. Do you know what the term for that is?
Inflation.
Right. Well, there's an interesting parallel here because so we call it in money terms as well.
Yeah,
And that's really what inflation is all about.
exactly.
So today, if you were excited if we dropped $1,000 in everyone's lawn, by the end of today, you should figure out why you maybe shouldn't be as excited.
Yeah.
But we'll get to that.
All right. So before we go on, I don't know if we touched on this last week, but does everyone know what the grading policy is? So you have to go to 2 Baker Institute events, or any event on campus for that matter, right? And you have to submit the 2 200-word write-ups. Is everyone I think we talked about it last week. Just want to confirm. So you can do that whenever you want through the semester, but just email it to both of us. The write-up. You don't have to print it out. We're trying to be a little environmentally friendly, right? So just email that to us whenever you go, and try to do 2 before the end. And there's no more events, then we're kind of in a bind here, right? So there are many opportunities we showed last time, right? So in fact, we'll pull up a couple more things. So this is the Baker Institute website. So I don't know if anyone's gone to any of the events yet from the year, but I don't know, where are we here? The 23rd. So we have religion, the 2012 elections, Switzerland's role as protecting the power of the US. So I think everyone remembers, right? If you want to go to one, you just click here and then you do the RSVP thing, right? Everyone's good with that? So I think these are all usually very good events. This one should be very good if people want to go to this. Religion, the 2012 elections. Michael Lindsay is a really, really smart guy on this. Bill Martin, Neil Lane, these are all very, very smart people. So this would be very good, probably. So the other thing is tomorrow is a big day. Raul, can you explain why?
Yeah, does anyone know why tomorrow's a big day? Yeah, it's good. So tomorrow.
What is the State of the Union, by the way? Does anyone want to tell us what it is? What is the event, the State of the Union? Why does it happen? What goes on there?
I think it's the annual address where the president talks to the country and tells them where where the country stands on all the main issues that they've hit over the years.
Right, it's exactly right. And my understanding is that it's actually part of the Constitution. You actually have to do it as part of the Constitution. That's my
I
understanding.
didn't know that, but that's interesting. Yeah. But yeah, it's a big deal, particularly since it's an election year. So everyone's eyes are gonna be on it. So one thing we do every year, sort of all the political clubs at Rice, the Baker Student Forum, the Rice Democrats, and the Rice Conservative Forum have this sort of viewing party, State of the Union. It's a lot of fun. It's really nerdy, but it's a lot of fun. You should check it out tomorrow at 8 p.m. in Sewell Hall. Yeah,
We'll post the event on. I don't know if we can post the event on the Owl Space.
yeah, we can link to the.
Okay, yeah, so we'll link to the event and just RSVP if you want to, or just show up. Doesn't really matter. So it'll go from 8 to 9ish, and there's a what's called the response, right? So then, one member of the Republican Party will respond to what President Obama says. So Governor Mitch Daniels of Ohio, Indiana, is going to respond. So it should be a very, very good event. I encourage you all to come. And again, this can be one of the write-ups, right? So you can come to this, watch State of the Union, and just write up 200 words on that, and that counts as one, right? So you can get it out of the way, and this will be a great event, right? So the last thing.
Yeah,
you
so-
wanna explain this.
Yeah, so last week, not
So
last
skip
week, I guess
briefly.
2 weeks ago, our very first lecture, we talked about the budget, right? We heard budget a lot about fiscal policy. So if you're interested in sort of figuring out more in depth sort of what components affect the budget and fiscal policy and sort of where the government can set priorities, this little really cool game produced by American Public Media called Budget Hero. I mean, it's a little corny, but the point is you can sort of play around and see how different policy decisions affect the trajectory for the U.S. I mean, it's a way of sort of virtually being in the Oval Office and seeing how that plays out. It's actually really educational. You can learn a lot. I even learned a lot playing through this, and it's a good way to sort of formalize what you learn in class and sort of experiment to see what happens when you tweak different things.
Yeah, if someone wants to do this and then send Raul and I an email with your proposed budget, we'll be happy to discuss it with you over
Yeah.
office hours, right? No one has come yet. I'm very saddened by this, right? Mondays, Fridays, lunch, McMurtry, right? Basically every day, but guaranteed Monday, Friday. So yeah, just another great thing.
Yeah, and we'll link to this on the Outspace.
Yeah, this is really awesome.
And all of these, so it'll ask you certain things okay, do you want to institute a carbon tax? All those
Yes.
calculations that they make are all rigorously stored and everything. It's all very factual. Anyway, you should just check it out. So.
Okay.
And then sort of the last thing that we talked about last time, we're going to throw up a poll on the Outspace after this class, get some feedback on what you liked, what you didn't like, things we can improve, suggestions. And then last semester, we incorporated a lot of suggestions we got from students on the fly. So this can be done either, again, through the poll, or you can informally talk to us, shoot us an email, so whatever you prefer, we're very open.
Okay, and now one thing that we like to do at the beginning of every class is just go over a couple of current events from the past week. So in this case, it's the past 2 weeks.
And actually, this came out of a student suggestion.
This came out of student suggestion, that's right. So the first thing we want to talk about, has anyone been following the Republican primary? Can anyone brief us on what the update is? Who wants to brief the class very briefly? Go find something. Okay, no one has been following this? Okay. Who are the candidates for
I just know
now?
that Newt Gingrich beat Mitt Romney, and I think was it Iowa?
South
Okay,
Carolina.
okay, so everyone knows. Good. Okay, so we have Newt Gingrich, right? We have Ron Paul. I'll just write the first names since we're on first name basis with them, right? And Vint. Okay. And yeah, so Newt won South Carolina. Do you guys know the other states that these guys won?
I haven't thought that now.
Oh yeah, sorry. So this is Rick Santorum. I'm sorry. Yeah.
Yeah,
Yeah, Rick Perry has dropped out. Yep.
Santorum won
Iowa.
Yeah, Rick Santorum won Iowa, right? And Mitt Romney won
New Hampshire.
Yeah, good. So basically this is how the parties pick their nominee, right? So each state has this the majority of states have this primary process, right? And depending on who wins the states, that person becomes the nominee, right? And it looked like Mitt Romney was just racing ahead, right? But then surprisingly, Newt just won in South Carolina, and the next one coming up is going to be Florida. And a poll from today just showed that Newt Gingrich is actually leading there. So this could go on for a long time, right? And we should continue to watch it right throughout the class.
Yeah, what's really fascinating about this Republican primary, it's a really compelling case for political engagement, right? Because you see in Iowa, Rick Santorum actually ended up winning about 34 votes. So that's a testament to the fact that every vote counts, right? So you never feel that it's just going off into this pool and your sort of individual decision will not affect the outcome, where it clearly does. And because it's going to sort of drag on, you're going to see really the sort of backgrounds, the policies, and the ideologies of these candidates come out very strongly, and it gives the American public a chance to get to know these guys a little bit better. So it's a compelling case to be made there.
Okay, now the next. I wish we had a bigger image, but anyways, let me just briefly. Maybe this one.
Yeah,
Okay, this is much nicer. So this is area right here. Okay, it's called the Strait of Hormuz. Now, what has happened is a lot of oil ships through here. So I notice it says shipping lane right here. So Iran, right, has threatened to block this strait off right here. So if they were to close this, then all this oil from the Persian Gulf, Saudi Arabia, Kuwait, Qatar, etc., would not be able to go to the world market, right? So that would dramatically increase the price of oil, right? I mean, if there's like less supply, same demand, price is going to go up. So Iran has been taking a lot of steps here because the West, right, has been placing sanctions on Iran as Iran gets closer to developing a nuclear weapon.
And this is sort of something that's flared up very recently. There's a report that came out a few months ago where basically it became very publicly known that they were very close to developing nuclear weapons, or well along that path. So they've become sort of very aggressive recently. They've been patrolling their, basically their navy,
Yeah.
and sort of in a show of force. So we'll see if that develops, but the counter argument there is if Iran shuts off the Strait of Hormuz, sure, the rest of the world suffers because of the lack of oil, lack of access to oil, but Iran also suffers, right, because it's a major export for them. So it's sort of a mutually assured destruction type of thing.
And just another very quick thing on that, a lot of countries now are deciding to boycott or embargo Iranian oil. That's to say they're not gonna buy oil from Iran. So the EU, right, which we'll talk about in a few weeks, right, is the European Union, 27 countries. They said we're not gonna buy any oil from Iran. And Japan has done that. China is looking like it might also do that. So basically the entire world, or the majority of the world is kind of boxing Iran in, so we'll see how that plays out. And Raul, you want to preview State of the Union real quick?
Yeah. So we talked about this a bit earlier, but maybe you guys are curious of what to expect tomorrow. So given the fact that this is an election year, given the fact that the economy is really at the forefront, we're still in sort of very high unemployment rate, upwards sort of the high 8% range, almost 9%, and it's sort of well accepted that the economy will take center stage, right? So this is going to be almost the start of Barack Obama's campaign platform, and he's going to try to make the case that his economic platform, his economic set of policies, is going to be the way forward for the country. So I think you're going to see a heavy emphasis on economics and highlighting some of the president's proposals the past year. Last State of the Union had a big emphasis on the American Jobs Act, which ended up getting stalled in Congress. And so since then, the White House has actually made it a priority to pass what are called executive orders. So basically, these are not laws, but these are basically just things that the president signs into policy that affect how different agencies in the executive branch sort of carry out business. So one example, the most recent example was he signed an executive order that streamlined the visa process to make America a more tourist-friendly nation, right? So that can boost like the hotel industry, for example, and a bunch of subsidiary industries. So anyway, that's sort of going to be the general focus. It's going to be all about the economy, which is why let's talk about in our first lecture and let's talk about today was particularly relevant.
Very timely. Yeah. So any questions on these things before we move into the topics for today? No questions? All right. So today, question. This is what the thesis is, right? Why this is not always so good.
Yeah. So first week, 2 weeks ago, it was all about fiscal policy, right? And really in modern sort of economic policy, there's two wings. There's fiscal policy and there's monetary policy. So in a way, this is sort of the second half of you guys getting sort of the fundamentals of what goes on in the Treasury and the President's National Council of Economic Advisors.
So can someone just briefly remind us what is a fiscal policy? Who remembers from 2 weeks ago? Just I don't want to gloss over anything. Maybe we did a really bad job of explaining it. No one remembers. That would be very bad. Someone bail us out.
Max,
Max,
you
you can tell us?
rejected.
That's when you use monetary policy, like inflation versus.
Right. So yeah. So that's monetary policy. What's fiscal policy? We talked about.
Oh,
2 weeks
fiscal
ago.
policy. That's when you. That's when you.
Isn't it just how they decide how to spend their budget?
Right.
Yeah, that's
So-
like selling the Ponzi.
Taxes and spending.
Yeah.
That's it.
Right. So that's the two key words that all we really expect you to
Yeah.
hold on to, if nothing else, from the first lecture: tax and spend.
So monetary policy, right, is exactly what Max said, which deals with inflation and money supply. We're getting into all this, but the first thing you have to realize is monetary policy is controlled by an organization called the Fed. Okay, and that stands for the Federal Reserve Bank. Okay, and now this is an organization that is semi-apolitical. Federal, okay. So this is one thing you'll like notice, right? My spelling sucks, right? So please feel free to. So it's a semi-apolitical organization, right? That is to say, it's kind of independent, right? So the president appoints a head, but the head has to be confirmed by the Senate.
Right. So the current head is this guy, a guy named Ben Bernanke. And like Rod said, selected by the president. He's actually selected by George Bush Jr. So right before Obama, and he's been kept in by the Obama administration ever since.
But once he gets confirmed, he does not have to like listen to the president. That is to say, the president is not saying, "Hey Ben, do this," right? Bernanke, along with some of his advisors, they're the ones who are sort of taking unilateral decisions. I mean, obviously they have their own goals, and we're going to get into what those goals are in a second. But I mean, Barack Obama is not calling them and saying do this. John Boehner, who's the head of the House, is not calling them to say do this or whatever. Right? He's independent now at this point.
And this is by design, right? So the natural inclination when you hear about this is, well, doesn't this sort of go against the democratic process, right? Because this guy Bernanke can basically do whatever he wants, right? He's not highly accountable. I mean, he's semi-accountable, but not really. But sort of the reason this was done, really this goes back to Alexander Hamilton, right, in U.S. history class, talking about the establishment of the central bank. But monetary policy is thought to be immensely complex and requires technocratic control. So Ben Bernanke is a PhD in economics from Harvard or MIT. I mean, all these guys that run the Fed, they're all extremely knowledgeable, and it's really something that's outside the purview of most politicians. And so the Fed was designed to be independent so that these banking decisions, these financial decisions, were A, kept independent of any sort of special interests or conflicts of interest, and B, given the requisite amount of technical background by the leadership.
So the Federal Reserve does two things, right? The first thing they do is they set interest rates. This will be spelled wrong, I'm sure. Okay? And the other thing they do is they change or select or decide, whatever you want to say, the money supply. So we'll get into both of those, right? And they also have two goals. Bro?
Yeah, so before we go into the two goals, one thing I want to draw is you can sort of use these parallels, right? So in the same way that fiscal policy is really about taxing and spending, monetary policy is really about interest rates and money supply. So these are the two key words that you need to remember here. Now, in parallel with these two sort of pathways that the Fed can use, there's two goals, right? So one is to manage inflation, which we alluded to earlier, and the other is to control the unemployment rate. And basically, those two goals are managed by the first two pathways. So for all the technical complexity of monetary policy, which we're not going to get into like a PhD dissertation on like how bond markets work, but really to really understand the decisions that this man makes, it's really just about understanding what happens to interest rates and what happens to the money supplies. It is really that easy.
So let's start with inflation, right? So we said that one of the goals is to manage inflation. I think most people sort of picked up on the great inflation term, but the definition, the technical definition of inflation, it's not really important that you know this exact definition, but it's the general rise in prices of goods and services over time. So basically it's just prices going up over time. That's all it is.
And the really simple way to talk about this is you guys have had like grandparents that said something like, when I was a kid, 20 cents would buy you groceries for a week, right? I mean, that is in effect inflation. And maybe you guys have even observed that over the course of your lifetimes, right? I mean, I mean, I remember when I was a kid, $20 would get you groceries for a week. Right now, that number has climbed steadily. But that's not necessarily a bad thing, which we'll get into.
So before we go on, we want to see this graph. Okay, this is a graph of U.S. inflation over time. So this is the percent, basically the percent change in prices over time.
Right. So we just sort of threw this up to give you a historical idea of what inflation rates to expect year over year. So as you can see, we're actually at somewhat of a historical low over the past, 20, 30 years or so. And we're in this very narrow range of probably about, well, now we're kind of below zero, but historically we've been in this band of 0 to 4%.
That's exactly right. And by the way, when you get into this negative portion, it's called a deflation. So that's just the exact opposite of inflation. So inflation are prices going up over time, right? Deflation are prices going down. Right?
And really, if you talk to most economists, they will say an inflation rate of around 3% is a good target. And the reason for this number, I think it's kind of arbitrary, but the reason is you want the money supply to grow roughly in pace with A, the population growth, and B, economic growth, right? So you want enough money to go around, want to keep it roughly stable, and deflation can also be just as destabilizing as very high inflation, right? So you want to keep it within a very controlled band.
So I want to give you an example of why inflation is good for people who are borrowing money and bad for people who are lending money. So I think this example will just illustrate it perfectly. So this is actually a true story, right? So I think this is in Zimbabwe. I don't know exactly, but I'm pretty sure it is. So in Zimbabwe, they had very, very high inflation. This is what we call hyperinflation, 100, 200,000%, I think, at times. And someone borrowed money for his house. And when he borrowed money, that loan, was not indexed for inflation. That is to say, the loan did not increase based on inflation, right? So it was just like he borrowed $100, so he owed $100. That's it. But the country was experiencing inflation. So like the price of like milk was going up very much, matches, whatever. Like every good, the price of that was going up. So the guy went to his banker and he said, here's a box of matches, right? And it's now worth $100. So that pays off my mortgage. Does that make sense to everybody? So the price of matches was going up so much because of inflation, but the mortgage was just a consistent amount, $100, let's say, or $1,000, whatever it was, right? So then the matches became worth $100 because they're going up by inflation. So he just like takes the matches to the banker and says, here's my payoff of the entire mortgage, right? So obviously inflation was good for the borrower in that case, right? Because obviously the house is worth a hell of a lot more than the matches, right? But because of how inflation works, right, it's good for borrowers, right, and bad for lenders.
And this is why high inflation needs to be controlled, right? So, this was way before our time, but when you're in this like 12 to 16% range, back in the 70s, that was sort of the dominant topic of politicians and in the media, because sort of runaway prices causes these sorts of distortions and sort of changes the balance between creditors and lenders. People aren't going to give out money because the money could be worthless, right? And no one's going to save money. They're incentivized to just go out there and spend it right away. So it causes a lot of problems. It's out of control.
So this is just a quick graph globally how inflation looks. So I don't want to spend too much time on this. We'll throw these slides up online so you can dig around later on. Basically, it's very varied based on the country. That's all we try to show there. Okay. So the question now becomes, right, how is the Fed, right, the Federal Reserve, going to control inflation and unemployment, right? Because we said those were the goals, right? So the question now is, how is it going to do it? So again, we just want to review. There are two tools, right? There are two ways it can do it, right? One is the interest rate, and one is the money supply. So let's start with the interest rate.
Yeah.
Bro?
So very simply, increasing interest rates decreases inflation. Okay? And you might think, well, interest rates of what, right? Are these the same interest rates when I go to the bank and open a savings account? What exactly does that entail? So there's actually a complicated mechanism by which the Fed can set interest rates. So we don't want to get too into that. But just to give you a basic idea, the Federal Reserve loans out money to banks. Okay, so Ben Bernanke says, all right, Bank of America, we'll give you $100 at 1% interest rate. So in a year, just give it back to us at 100 a month. But in the meantime, you can do whatever you want with it. So then Bank of America takes that $100 and well, gives it to you, or like loans it out if you want to buy a house or buy a car or buy a TV. They loan it out at higher than 1%, maybe a 3% interest rate. So they take the 2% cut, and then give 1% back to the Fed. So the point being is that when the Fed raises interest rates, they're not directly affecting the interest rates you take on a loan, but really that's the upshot. That's what ends up happening. So the point is the Fed can unilaterally control the rates, the market rates of interest. And the reason that increasing the interest rate decreases inflation is because all of a sudden, if the interest rates are very high, you're not incentivized to go out and borrow. Because if you go out and take a loan to buy a house or buy a car or buy a TV, you're going to have to pay it back at a really high interest rate, right? So you're incentivized to just hold on and not try to like get a bunch of borrowed money and go out and spend it. So what that does is it curbs people's spending, which lowers demand and brings prices down.
So, yeah, that's the perfect example. So we can just diagram it here because I know some people are like visual learners more than auditory. So the Fed loans money to the bank. Let's just say Wells Fargo, it doesn't matter, Bank of America, JP Morgan. So they're loaning Wells Fargo money so that Wells Fargo can loan all of us money to buy a house or a car or whatever. Right? So they're charging Wells Fargo a certain amount of money or a certain amount of interest, right, to borrow that money. So let's just say they're charging them 1%. And Wells Fargo's like, you know what, we need to make 3% on every single loan we make. Right? So if Wells Fargo needs to make 3% for them to run, and they're getting charged 1%, they're going to charge you 4%, right? So they can make that 3% spread. Well, so what happens if the Fed says to Wells Fargo, well, you know what, we're going to start charging you 3%. Well, Wells Fargo's got to cover its spread, 3%, so this goes up to 6%. So now you go to the bank and you want to get a loan, well, 6% is higher than 4%, you're probably not going to take the loan. In fact, what you're going to do is you're going to put your money in the bank so you can get a higher return on it, right? So you know, like when you guys put your money in the bank, you get some interest on it, right? That also varies with this. So the upshot of it is, as the Fed changes this rate, that affects your rate, and then you, as the consumer over here, make decisions. Okay?
Now the converse is also true, right? So let's say that earlier in the graph you saw that we were getting below zero, right? So we were in sort of this deflationary cycle. Well, that's not always the greatest thing either. That also causes distortions, right? So what if the Fed says, well, we got to increase inflation? Then they would just do the converse. They would lower interest rates, and the exact opposite would happen.
So I know this like sounds very theoretical, but this is happening today, and we'll give you two examples of two countries doing exactly the opposite policies. Right? So India right now is having huge inflation. Right? So the central bank in India, their Federal Reserve, right, is jacking up interest rates that it charges to banks to try to control the inflation. Conversely, Sweden is experiencing this deflation. So Sweden Central Bank is actually charging negative interest rate to try to do anything it can to get the banks to loan money. Right? So these are like real things that are happening today. It's not some like abstract. I know it sounds very theoretical, but real policymakers, like the Ben Bernanke's of the world, of like each country, they're thinking like, how can we change this to sort of correct inflation?
And small adjustments in the interest rate can produce pretty drastic differences in economic behavior, right? So again, this may seem sort of abstract, as Rod said, very theoretical, but it has profound implications for how an economy behaves. And one could argue that it's even more important than fiscal policy. But that's sort of a discussion for another time.
Yeah. So let's now switch to talking about money supply. So we showed up sort of like how the interest rates can affect it. So now let's talk about money supply.
Right.
So, Ro, you want to take this one?
Yeah. So money supply. There's a finite. You can think of it this way, right? So there's a finite supply of money, just in the same way that there's a finite supply of Apple computers. Okay. So you guys probably have this intuitive understanding, which is that, okay, if I'm Apple and I'm selling, MacBooks, if all of a sudden I cut my supply of MacBooks in half, but people want MacBooks just like they've always wanted them before, what do you think will happen? So the supply of MacBooks goes down, the demand stays the same. What's the upshot on the price? Price goes up, right? It's all very intuitive. Same thing happens with money. So we can draw out the supply of money. So I know some of you guys are graph phobic, so we'll try to explain this both auditorily, and visually. We can very easily represent the supply of money and the demand of money, right? So these are your standard supply demand curves you may have seen in high school and Econ 201 or whatever. But the point is, if you increase the supply of money, so you shift out the.
Oh yeah. So we're gonna increase the supply of money. So I mean, just before we get there,
Yeah.
this is, I mean, so this axis is the quantity of money that's in the market. You can think of it, and this is the value of the money. So the way you can think of this is like how much milk does $1 buy, right? I think that's the easiest way to think about it. So the higher this is, the more milk a dollar buys. It's probably the easiest way to sort of intuitively think about it. Or I mean, gas or anything, it doesn't have to be milk. Okay, so what happens when we increase the supply of money? Okay, this is S prime. Well, obviously this becomes the new point, right? So what has now happened? Anyone tell me what has happened to the value of the money? Okay, it's gone. So if the value of money has gone down, that means inflation has gone up or down? Up. Very good. So that's the intuition. It's that simple, right? So as you increase the supply of money, right, the value of the money goes down. So that means you can buy less milk per dollar. Alternatively, that's like saying the price of milk has gone up, and that's inflation. So is that clear to everyone? Please ask the questions now if it's not clear. Okay.
And the converse is also true,
Yeah.
right? So if we were going the other direction,
Yeah.
let's say you started at S prime,
Yeah, exactly right.
and we decided to increase the money supply.
Decrease.
Right, sorry, decrease the money supply, then inflation would drop, and a dollar would buy you more milk, right? There'd be more value to the dollar.
Question.
How would you decrease the money supply?
Ah, very good.
Great question. There's a lot of
So
mechanisms.
this is kind of more technical.
Yeah.
So it's probably easier to say like how you increase it, just like printing more, right? So decreasing it is basically the government sells bonds to people, right? And people buy those bonds by spending money, and then that money that's used to buy the bonds is just like kept out of the market. That's the easiest way I think to explain it. It's more complex than that, and there's like whole courses on this, and like we're happy to talk more about it afterwards. But that's, I mean, basically, it's the government basically sells bonds, people buy those bonds, and the money that they spend to buy the bonds is just kept out of the market.
Also, they can buy the bond back.
Also, they can buy the bonds, yeah. Okay, so, yeah, question.
When you say value of money, do you mean the interest rate or do you mean the international value of the currency you have?
So I mean, like, what can I buy with $1?
In relation to previous times?
Exactly.
Yes.
Exactly.
The temple.
So what can I buy with $1 today versus like 10 years back? Right. Okay. So now, I guess this will be sort of like a thought question for everybody. What do you think happens if the value of money changes? Right. So let's say that the value of money goes down. Right. So basically, you're experiencing inflation. What do people think happens to exports and imports? This is really challenging. This is a really, really tough question. And hard for even like Raul and I to understand initially. Yeah.
So if prices in your country are going up, you will look to the world market and say, okay, they're cheaper, so you want to get their stuff because your internal stuff is expensive. So you will start importing more. And if your stuff is cheaper, as in your inflation rate is low or you're having deflation, then the outside markets are going to look at you as a cheaper outlet, and you're gonna be exporting to them.
Right, right. But strictly in terms of like the money supply, for example. So let's sort of toss out. Let's toss out let's not think about inflation or interest rates, right? So let's think strictly in terms of money supply, right? So if we start printing, it'd be twice as many dollars as we did before. So we increase our money supply by 2. That means $1 buys you half as much milk as it did before, right? But, let's say that, are you drawing out the money supply graph?
Yeah.
Okay. So at the same time, let's say that the currency rate, the exchange rate between the euro and the US dollar, so it'd be like 10 euros for $1. If the US dollar buys you less, your prices go down relative to prices in euro. So this is very counterintuitive.
Yeah.
I mean, maybe visual representation.
Maybe we should do an example. Sorry, we
Yeah.
should have done the example
Yeah.
first. I'm sorry, we did not do it right away. So let's think about it this way. We'll use like a real life example, right? So China and the U.S. This is the easiest example to use, right? So let's say that $1 is equal to 5 yuan. Okay. So you're like Dell, let's say. So you're making this computer in China, okay? And it costs you like 100 yuan to make. That'd be a really good computer, a really cheap computer. Could get that for 100 yuan. So if the computer is 100 yuan, how many dollars is that? 20 bucks, right? Exactly. So now China can sell me this computer for like 20 bucks, right? But now what happens if the yuan gets weaker? Well, so if the yuan gets weaker, that's like saying now that $1 is equal to 10 yuan, right? So basically it takes more yuan to buy a dollar. So each yuan is weaker.
And it would get weaker if the Chinese government increases the supply of yuan.
Right?
Does that make sense?
So now the same computer, it still takes 100 yuan to make. How much does it sell for now? 10 bucks. So before it was 20 bucks, now it's 10. So by the currency becoming weaker, you can export more. Yeah, question.
Why would it still only cost 100 yuan to make, wouldn't it?
Because I'm not paying my people any differently, right? I mean, I still just like pay you like 5 yuan, let's say, to like do the work, right? I don't like the central or the Federal Reserve's decision to like increase money supply doesn't affect me as like, so like when I hire you, like a contract's written, I'm gonna pay like 10 bucks an hour. I don't care if the 10 bucks buys you like a gallon of milk or 1,000 gallon of milk.
Right.
To me, I don't give a shit about that. Yeah.
Isn't the point in like inflation a measurement of the price of goods going up?
Right.
So wouldn't this be a goods that has a price that's higher? I mean, is this like adjusting for inflation and like hyperinflation? They haven't adjusted in the company, or what is it that?
Yeah, Ron, you want?
Yeah, I mean, this is your question of like, why are they not adjusting their prices to reflect?
Well, yeah, I mean, if inflation is a measurement of increased prices
Right.
of goods, and that's a good, why would that? How could that not? Why wouldn't that price be raised?
Oh,
If
okay, so yeah.
inflation is a measurement.
So I guess we're talking about in terms of the international economy, right? So in China, if your yuan buys you less value, okay. So for example, like we're using the example of computers here. So if 1 yuan buys you like 1 computer, and you see like inflation to where the yuan value is cut by half. So 1 yuan buys you half a computer now. Your price effectively went up. But to people in other countries, the price has gone down, right? Because inflation for them is sort of contained in their own country. So all we're saying is your exports become cheaper. So domestically, your prices may have gone up. But on the international market, you're comparatively cheaper.
Yeah, no, that makes sense. I'm just asking, like, if it's 100 yuan, wouldn't it be higher than that for like domestically, like for the people in the country? If they saw inflation and we saw an increase in the exchange rate from $1 to 10 yuan, wouldn't we see that their prices are raised and that the computer costs more than it would? under other circumstances?
Practically yes. I mean, we
But-
basically simplified.
But like relatively, it would still be
Yeah,
an
you're right.
advantage
You're right.
Yeah.
You're right.
globally. Okay,
Yes.
that makes sense.
This is just to simplify the.
Yeah.
Yeah, no, that makes
But you
sense.
get screwed on the imports, right?
Yeah.
So now because each yuan is worth less, if you want to like buy something from the U.S., it's more expensive now, right? Because now it takes 10 yuan to buy $1, right? So if something's made in the U.S., I don't know, we don't make anything anymore. If like a Boeing plane is made here, right? Right, that's like the only thing. And it's like $1 million, right? Before it only cost 5 million yuan to buy it, but now it costs 10 million yuan to buy it, right? So that's going to be more expensive for the people in China. So the upshot of all this is, as your currency becomes weaker, your exports it becomes easier to export, harder to import. That's all we wanted to say. Sorry, we got off on this tangent here.
Yeah. This is really confusing, but even if you're not really too comfortable with like the math and all that, that's not really important. The key thing is just to understand the raw level intuition, which I've just talked about. And what's interesting about this example is that this is actually happening. China. This actually comes up in the primaries and the Republican debates a lot. People talk about China manipulating its currency to make itself weaker to boost their exports. And we're not going to get into like how the trade policy works, but countries actually do this, right? So they manipulate their currency to make to allow themselves to manufacture and export more goods to raise their economy. So anyway, just a side thing to consider. So the upshot is that in tandem, by adjusting the money supply and adjusting the interest rate, you can combat inflation and the unemployment rate, right? So, for example, what's commonly done is to increase the money supply and to decrease the interest rate. So you might think, well, these are basically counteracting policies, right? So the former, so let's have like a basic breakdown. So what effects do you guys think that, number one, based on what we've told you, how does it affect inflation, and how does it affect unemployment? Do you want to just take a wild guess?
And this is not easy, and don't be afraid to say the wrong thing, because it takes. I mean, even I have to go back and think exactly how the mechanisms work. So please be free to make the guess. So you're increasing the money supply, right? What is that going to do to inflation? Anyone take a guess? Yeah, that's right. To increase inflation, just because the previous graph we showed. So we have that increasing the money supply, right, leads to increasing inflation. Okay, good. And now the upshot, and so then the other question is, what does that affect? What effect does that have on unemployment? This is a little bit tougher to see, but I think you guys can do it.
Did the price go up because of the demand changing, or will the demand be affected by the price?
So, I mean, that's a very complicated question. Without getting too into it, the price is going up. Well, the demand is being affected by the price.
Yeah.
Yeah.
So basically price goes up, so demand goes down.
Right, well, okay, so basically what you want to think of is, I mean, in this case, you really want to think of demand as being constant, okay? So what we're interested in seeing is how prices are adjusted independently of demand. So, without getting into a lecture, so increases in demand can increase prices, right? So the MacBook example which we talked about earlier. But at the same time, your demand can be held constant, and by adjustments in the money supply, prices can go up anyway. So what we're saying is, assuming demand stays constant, if you just increase the money supply, what happens? So what you want to do is think of this in terms of
Let's do this.
access to credit.
Let's do this. Think about it on a micro level. So I come to you and I give you $1,000. What are you going to do with at least a portion of the $1,000?
Save it.
And the other portion? Spend. Good. Okay. So now this goes back to last lecture. When you spend money, how does that affect the economy? Right? So you go to Specs, right, and you buy whatever you buy there, right? Then what happens when you get there? Right? So you give money to the guy, right? And then the owner of Specs gets money, right? And then he pays. So sorry, everyone. This is probably too low, but let me just draw this graphic or this diagram, because I think it'll help everyone see what's going on. So you go to Specs, right? So this is Specs, right? And you give him, let's say, $100. Okay? And then what does the Specs guy do? He pays a cashier, right? He pays the guy who does the cleaning, right? Right? So then the cashier, right, he takes his money and goes to Subway, right? And what does he do at Subway? Yeah, he spends some money on the sandwich, right? So what's happening in all these steps along the way? You're spending money, and by extension, they're paying someone else, and jobs are being, right? Yeah, sorry.
So basically what I'm trying to say is that by decreasing inflation, then it's going to decrease the unemployment rate, because people are going to have, if they put more money into the business, then the business will have more money to hire more people.
That's
Yes.
exactly right.
But yeah, that's exactly right. If you want to think about it as increasing money supply decreases unemployment. You don't have to. I mean, you can skip the inflation step. But yeah, that's exactly
And this is because wages aren't changing
correct.
during this period.
Exactly right.
So do wages usually change?
But they usually do.
Inflation?
They usually don't. And that was the genius of John Maynard Keynes. Right? He said that wages are what he called sticky because they don't change. It's when someone hires you, it's $10 an hour for the whole year. Right? So that's not going to change. So that was the genius of John Maynard Keynes. Part of it. He has a lot more genius. But anyways. So this is the upshot. Okay, that's exactly right. So when you increase the money supply, people like have more money to spend. They spend it. That boosts the economy, reduces unemployment.
Right. So the other mechanism we had on board earlier was decreasing the interest rate. Okay. So the hint here is that it's going to have the opposite effects. Okay. So what happens to inflation when you decrease interest rate?
Decrease or increase? What do you say?
Decrease.
Decrease interest rate. Okay.
So the interest rates that banks give out on loans, for example, goes up.
No, you're decreasing interest rate. So that,
Oh, sorry, I said decrease. Okay, so goes down. So what effect will that have on inflation?
think about it again. Micro example. Think about it just like your own example. You go into the bank, interest rate goes down. Are you more likely to borrow money now than you were before? Consensus class, yes, no? Interest rates lower, you're more likely to borrow money. What are you going to do with part of that money? You're going to spend it. Where are you going to spend it? Specs. What's Specs going to do? Give it to the cashier. The cashier is going to spend it at Subway. Right? So what's going to happen? If you lower the interest rate, the unemployment goes up or down.
Yeah.
That's it. You've
Yeah.
solved the crisis.
Yeah.
Right there.
So it really is that simple. And the real life examples of this, right? So, for example, in the money supply range, the Fed has in recent years done what's called quantitative easing. So you may have heard about this, but basically all that happens is $600, $700 billion at a time. They print a bunch of money, put it into the economy, and then, in effect, to lower the unemployment rate and to improve the economic outlook. Right? So they've done this actually 3 rounds of this. It's been pretty massive every time. And again, I mean, has it had an effect? Maybe, maybe not, right? So we don't know the counterfactual. But the point is, these are all efforts being taken by the Fed. And the interest rate tool, the mechanism, is also being employed. So the Fed right now has set interest rates at around 0.25%, which is at like record lows, like historical lows. So, I mean, that's
This is basically what you want to see, the interest rate.
Yeah, so this is
the yield curve. It is the same thing.
yeah, these are basically the interest rates. And this graph's kind of hard to see, but these
Look at
dates on the left.
Look at the bottom row, right? So this is from the 20th, so like 3 days ago, right?
Yeah, this is the most recent. So what?
So the interest rate on 1 month of debt is 0.03. That's like nothing. 0.03%. That's less. So if you borrow $100, you owe back
3 cents.
not even 3. No, yeah, no.
What is this? 3%.
Yeah, 3 cents. Everyone's gonna borrow money then, probably, right? I mean, if you can make more than 3 cents in a month, you ought to borrow the money. That's basically what the upshot is, right? And this goes back to a Sweden example with the negative interest rates. Negative, right? So they're paying you to borrow money because they want to jumpstart their economy.
Yeah, because if you take into account inflation here, you're actually having a negative, what's called a negative real interest rate. Okay, so this is the nominal interest rate. So this is also just an important distinction because this is talked about a lot. This is the nominal interest rate. This is actually like, like Raj said, 3 cents for $100. But if you take into account inflation, so if you take into account the fact that if there's like over a year's time, it devalues by 10%, you really have a negative 7% real interest rate. Again, these are always sort of somewhat confusing, but the upshot is these rates don't take into account inflation.
Yeah.
So once you put in that calculation, those rates end up coming down even further.
So yeah, so this is just the like handy formula, right? So like the real interest rate is the nominal rate minus inflation, and a pi is just the symbol that economists use for inflation. Right? So is everyone good with sort of the broad contours of using the tools of increasing money supply and changing the interest rate to affect the economy? Yes.
So when they do this, though, I can't imagine that they can do it in like a continuous way. It has to be like a short burst because if you do create inflation, then eventually wages are going to increase, and that's going to create a problem all over again, right?
Yeah, that's a very good point. And that is actually a nice segue into the next part.
Yeah, so one thing that often gets talked about is sort of the role of the dollar, right? So everything we've seen so far with these interest rates and the monetary supply affects sort of how the dollar stands, the U.S. dollar, in relation to other currencies. And this is important because how the dollar stands in relation to other countries basically affects how willing other people are to invest in the U.S. Okay, because basically, if you are a foreign investor and you want to maybe buy shares in Google, you have to convert your money into U.S. dollars before you can do that. Okay, So if people have confidence in the US dollar, they'll be more likely to convert their currency into US dollars because they think, oh, well, it's going to be pretty safe, and so I'm better off making investments in the US. And so naturally, that has pretty big implications for our economic performance, right? So if people see our country as an attractive place to put their money in, that means it's more money for us, more money for Google, more jobs created, right? Is the basic outlook. But what we're seeing today is that despite all this economic trouble we had in 2008, the U.S. dollar is seen as a very attractive place to invest, and this is really less a reflection on how well we've been doing, and more a reflection on how poorly everyone else is doing.
Yeah. So let's first go back to your. Sorry, I don't think we answered the question exactly, but I think the upshot of your question, right, is that yes, like wages will readjust. So you can't just keep doing this forever, right? Because at some point people are going to be like, okay, you're going to do this again, so $1 is not worth that much, and that's the whole thing. But because people have confidence in the dollar, you can continue to do this, right? And people will continue to have faith that the dollar is not going to lose its value. Right, and that's basically what we're talking about here. So yes, wages will readjust, but then you can do it again for that next year. And because you're the U.S. dollar, people have so much confidence that they're willing to sort of put up with your sort of causing this devaluing of your currency.
So this pretty much only works in the US.
That's basically the option. I mean, not only, but yeah, basically, yeah. So I mean, sorry, just one question. So yeah, I mean, you can get to. I mean, this is not going to work in Greece or something like that, right? Or Trinidad and Tobago.
You know what it is? It's expectations matters a lot with monetary policy. We don't get to touch on that, so we don't have that much time. But how people see your currency, how people view the stability affects its actual performance. Okay. So I know you have your hand up, but just to have a brief interlude, because if all of you in this room expect the value of the dollar to go down by 10% by the end of the week, you're incentivized to spend your money right away. Right? Because your dollar today will buy you more milk or more computers than it will at the end of the week. Okay, so your expectation influences your pattern, which then becomes a self-fulfilling prophecy. Because if everyone in this room, or if everyone in the country, thought that inflation will rise dramatically, and you guys all spend money and spend all your money right away and buy a bunch of goods, then inflation will in fact rise because the price of the goods will come back up. Right? So the upside is expectations matters a lot. And the U.S. can get away with it because people have trust in the dollar.
Yeah.
Are we back to AAA rating yet?
No. Okay.
When
so,
do they put those out?
Yeah. So this gets into another thing. It's a good question. So basically, they're what are called these rating agencies. You guys may have been familiar with. Standard & Poor's is one. Moody's, Fitch, and basically they rate how safe investments are. So it's they're a global version of the FDA, right? So the FDA says these drugs are safe for people to consume. So the rating agencies are trying to say these investments are safe for investors to go for, right? Because if you're an investor from some small town in a country, you have no idea how the debt or how another country how stable that is. You might not know, but then you can go to these rating agencies. They're supposed to be neutral, right? So the rating agencies in August, right, downgraded the United States from the top rating to the second highest, basically saying the U.S. Their political system is not doing well right now, so we don't have as much confidence in them. So to answer the question, yeah, so we're still at the second highest rating, and they can choose to change it whenever they want. So they release them all the time. But as of now, it's not changed yet. Yeah.
How many ratings are there?
So it's AAA, then it's AA plus, it's AA. It's 1,000 of these, right? AA minus. You can see the pattern, right? We just keep going all the way down. And then I think so. If you want to look at Greece would probably be what is it in the C range now? B or C or triple C. I think Greece is triple C, right? And so AAA would be Canada, right?
Only 5 countries.
Yeah, it's very small. So AA plus is France, U.S. I think Italy's down here, probably AA minus or whatever, right? So, but again, this is all you can all look this up online. But I just wanted to go back to a quick point we had made earlier. So this is back to the previous diagrams. Let's get back to exactly what Rahul was saying. If you increase the supply of money, right, the value of the currency will fall, right? We just talked about this. So if I keep doing this, right, the value is going to keep falling, 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 and at some point people are going to be like, hey, I don't want to, invest anymore, right? Because your currency just keeps getting weaker, 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 weaker. But for the United States, what happens is when there's a corresponding supply increase, because people are so confident, the demand at the same time is also always increasing. So as demand's going up, supply is going up. So as a result of that, the change, right? So initially you went from here to here, right? But now that demand is higher, right? You're only going up to here. Does that make sense to everyone? So because demand goes up, the decrease in value is less. That's what I'm trying to say. And this increasing demand right here is reflective of the increasing confidence in the dollar. Or maybe said better, the increasing lack of confidence in any other currency. Right? So I mean, just imagine that like you're the head of the Saudi Arabia fund of like money. You have like billions of dollars to invest. Like, where are you going to put that money? Like, you want it to be safe, and you can't just like keep it under your mattress or take it to the bank. I mean, no bank is going to take billions of dollars, right? So you have to choose to invest it in some country, right? So like you have like a bunch of choices, right? You could invest in like, I mean, Brazil, India, China, Japan, US, any country you want. But all the other countries besides the US have legitimate concerns and problems. So as a result, people just might park their money in the US. And because of that, right, the demand, right, continues to increase. And as a result, we have there's a confidence in the dollar. Yeah.
When you're talking about investing, do you mean like they're buying bonds?
Yeah.
Okay.
Yeah. Exactly. And so a bond is basically the government issues. So bonds can be issued by anyone, but in this case, we're talking about government bonds. So the government gives you a piece of paper saying, if you give me $100, then a year from now I'll give you $100 and 1% interest, or in this case, 2% interest, or whatever this is. This is called the yield curve. So the government says basically, if you give me $100 today, in 30 years I'll give you $100 plus 3% interest. Okay. So any questions on that? And you can go like country by country, and each one you can find like a problem with it, right? So you look at India, right? Huge political dysfunction there, right? Growth is going to be very slow, right? China, the currency manipulation. Euro, like we don't even know if the euro is going to be around tomorrow, whatever, right? All these countries.
Yeah, we'll talk more about the euro at the end of the semester. The only problem is it may not be around
Yeah.
by the time we get to the lecture. So, but and sort of the interesting aspect, and the reason why these interest rates matter is because they affect fiscal policy, right? So this is where it gets interesting, because fiscal policy and monetary policy are fundamentally intertwined. Okay, so when the U.S. says, okay, if you invest your $100 here, we'll give you $103.10 in 30 years' time. What that means is we can borrow a lot right now and spend a lot. And that gives us more to spend on the fiscal policy side, right? Tax and spend. So again, if more people are willing to park their money here, that gives our government more leeway in what it can spend. In infrastructure projects, for example, or healthcare or pensions, right? We basically have more access to money, foreign money, okay? And what's actually really striking here is that, I talked about this earlier, because this is 0.03% real interest rate, nominal interest rate, the real interest rate is actually negative. So basically, people are paying us to hold on to their money for them, okay? So in a very real sense, other countries, China, for example, which owns a lot of, which has actually invested a lot of money in U.S. bonds, China says, okay, we will give you $100, and in real terms, you pay us back $97 in a few years' time. Right? It's a pretty good deal for us. So what that leads to is that there's a major policy discussion right now, where there's a school of thought that says, well, let's borrow a bunch of money right now at these historically really low rates, negative rates when you take into account inflation. Spend it all now, get our economy booming, get the growth going, and then we can pay it back later easily, because we'll have grown so fast the money will be no problem at all. But the counter argument there is, well, sure, these rates are low now, but if we start spending a bunch, people will lose confidence in the dollar, inflation will go up, and all of a sudden these 30-year rates are no longer going to be at 3%. They'll be at 10, 20, 30% like they are for Greece and Italy. So that's kind of the fundamental divide that we see in monetary policy circles, right, or in Congress, or even at the Fed right now. That's even real big.
So any thoughts, questions on that? Does everyone understand sort of the upshot of what we're talking about here? People are paying you to take their money, right? So you're stupid not to take it if you can believe you can at least pay them back that exact amount.
Right.
Right. So it's like your credit card company saying, "Hey, I'll give you $1,000 credit card loan at 0 interest, right? At the end of the year, you have to give me back $1,000." Every single person in this room should just take that deal, go invest $1,000 in the bank, get like a cent, and you've like made money, right? And if you're the U.S. government, you don't invest $1,000, you invest $1 trillion, and it's a lot more than a cent that you have to that you make, right? So that's one of the big debates. And in fact, the point Rahul brought up about the fact that if we just keep spending, right, these interest rates will go up. There were people telling Barack Obama that exact thing. He was trying to make a decision. And in fact, we'll put up a very long article, a very good article, which basically explains exactly how this happened inside the White House with the chief economic advisor to Obama was saying, don't spend that much because these rates are going to go up. He turned out to be wrong to the detriment of the country. But anyways, we'll put up this article and it's very good.
Yeah, but this is a really interesting debate, right? So even in these sort of very, like within the Fed, the economists at the Fed are constantly going back and forth, right? So what is the right approach? And we always like to spend the last few minutes of class a little bit of discussion. So we wanted to poll you guys, right? So we threw a lot at you, and this is probably the most like dense and probably hard to understand lecture we have all semester. But
Had to do it though.
Had to do it, but. Given the state of the U.S. economy, given through what you learned about monetary policy today, the basic framework, given what you know about these interest rates, and sort of synthesizing all the information you heard today and elsewhere, what would you do? Where do you stand on this divide of should we borrow a bunch now and spend it all, or should we wait? Is restraint more important, or should we focus on growth in the short term? What are your guys' thoughts on that? Intuition counts for a lot here as well. Yeah.
Solving unemployment problems has a lot to do with like sustaining growth of the well-being of people in the country. So I think like putting a lot of money out there right now, increasing the money supply at the risk of causing a little more inflation is the way to go.
Okay. Now, does everyone agree with that? So, because the counter argument would be, well, yeah, we could maybe the short-term solution would be to spend a lot and we would bring unemployment down, but these investors start to freak out because you're spending a lot. All of a sudden, we'll be the next Greece, right? So, does anyone feel that way? Or is everyone kind of on the same boat? Max, you're shaking your head.
What?
Let's hear it.
No, I mean
Which
like
way do you feel? Do you agree with what?
same, yeah.
Okay.
No
So
controversy
no one
there.
thinks like we should just like borrow. Borrowing another $1 trillion. Our deficit is already so huge. We can't afford this. Like this is a stupid thing to do, right? We're going to borrow $1 trillion. We already
Deficits
are
don't exist.
$14 trillion in debt, right? And you guys want to borrow more money? That's ridiculous.
But you look at it as a percentage of your GDP, not as an individual number.
Good.
But our debt to GDP is already at like 70%. Do you want to go to 100%?
We're not at 70%.
No, we are.
We are.
Actually, I'm not kidding.
That was a real stat.
Yeah, that was a real. We're at debt to GDP is 70. You could even argue that it's at 100% if you include debt that people in America own of the government. But you don't really need to include that because we owe it to ourselves, right? So it's not really a debt. So it's like so most people would say 70% debt to GDP.
Yeah, but that's the whole debt, but not the deficit of the per year GDP.
Oh no,
The deficit per year is 8%.
That would be.
Oh, that would be. You want to really begin that with that.
Oh man.
The deficit, which is each year, right? And that is about 8%. It's really what 8% of GDP,
It's not so.
and like 10% is considered like the red line. So we're getting awfully close. And Lauren wants to bring us even closer by borrowing more money.
That's the idea.
Yeah. So there's no one in this room that would do something different.
Well, I have a question. How, when inflation, like when money supply is increased, how permanent usually are jobs that are created by that? Like, are those
Great
jobs that are sustainable?
That's brilliant.
Great question.
That's
Or
brilliant.
are they just, kind of...
That is
Yeah,
brilliant.
and I think you were touching on this earlier as well. You're gonna see a debate, right? Because
Tomorrow you'll see this debate.
the answer is it depends. It depends on the type of job. Okay? So, what's sort of a simple way of
Look,
thinking?
here's the thing. If the government prints money to go build a bridge, most of those jobs are going to be gone in a couple months after
Because
the
it's
bridge
a
is
short-term
built out.
project.
right? If the government goes and says, hey, we are going to retrofit each and every school in this country to make it more energy efficient, those jobs are going to be around for a long time because there's a lot of schools to
So that's more of a medium term.
That's
right?
more medium term.
And then conversely, a long-term project would be, if the money is spent investing in scientific research, okay, and out of that research comes out some new invention. For example, like when we invented solar cells, right? That was a U.S. invention. Or Google, for example, came out of federally funded research. That creates sustainable long-term jobs, right? So you create industry around it. Those are jobs that aren't going to go away. So it depends on how that money is spent.
But you know what the problem is? It's harder to spend the money in the long
yeah.
term.
I was like, what's the likelihood of
It's really easy to spend the money fixing our shitty roads, right? It's really hard to figure out how I'm going to invest $1 million in science research to get the next Google.
Right.
So
Right,
that's the huge
but-
trade-off.
But I think that's a really good point, because in this debate of whether it's prudent to spend a lot in the short term, you have to consider that, right? Because even if you create a bunch of jobs that are around for a year or 2 years or 3 years, all that means is in 3 years' time, if your growth stops and you still have all this debt you haven't paid off, then you're kind of in trouble.
And that goes back to this Keystone debate. I don't know, we should probably talk about this as the current event. So
Yeah.
Keystone was a pipeline that was going to be built from Canada, right? And everyone was saying, oh, it's going to create a lot of jobs, a lot of jobs, a lot of jobs. Well, these jobs are going to be gone in a month, right? You're just creating jobs to build a pipeline. Those jobs are not going to be around forever, right? So again, let's get back to the point of short-term jobs. They help, again, in the short term, but a year later, person's back unemployed unless you can figure out a way to get going.
But the other thing you got to watch out about is, and we'll talk about this more with the European Union, but what we're seeing with Greece and Italy, right, these countries with very high debt, they had poorly managed fiscal policy, so in an effort to curb their debt, they're increasing their interest rate and they're decreasing the money supply. So if you guys have been paying attention, what that basically means is that increases unemployment, right, and decreases inflation. So they're actually causing economic contraction, right, because if you increase the unemployment rate, you can potentially induce a recession, right? People are out of jobs, so they stop spending money, which causes other people to get out of jobs, right? This is what we talked about in our first lecture. So what that means is they're actually, in some ways, inducing more debt problems, okay? Because think of the intuition. If you have a recession, if you have a bunch of people who are out of work, those are a bunch of people that aren't paying taxes. So all of a sudden, by cutting back, you're in fact inducing a deficit, and you get trapped into this cycle. Because then you have to cut more, which creates more of a deficit, which you have to cut more, right? So these are all sort of the complex calculations that go about because you have to avoid all of these pitfalls.
That's exactly right. And actually, we're going to talk about that next week when we do a case study between the UK and the US, right?
Yeah.
Because you'll see kind of exactly what Rob just talked about. So any questions, thoughts, concerns, comments?
The other very brief thing, I guess, if no one's saying anything, the other brief thing I'm going to mention is, what gets, particularly in light of this Republican campaign, that gets talked about is like the gold standard, okay? So I think Newt Gingrich went on record, was it a couple weeks ago, last week, saying that we should sort of get rid of the Fed and move to a gold standard. Ron Paul has been saying this for years. And actually, Robert Zoellick, who is the former president of the World Bank,
Still is.
he still is. He hasn't got. He's not for very much longer, but he came to Rice last year, I guess.
That's right.
But anyway, he also, while he was president of the World Bank, came on record and said, we should move to gold standard. So maybe you guys have heard this informally in the past, and you may be wondering, how does that affect everything? So what we'll say is, everything you learn in this class should theoretically, prepare you to figure out what happens if we move to gold standard, right? So based on the context of affecting interest rates and money supply.
By the way, gold standard means you set your currency to be equal to a certain amount of gold.
Yeah.
Right. So you say $1. So you say like $100 is equal to an ounce of gold. Right. So that's just like a fixed ratio you set.
So, and that's in contrast to what we have now, which is, it's called fiat money, but basically the dollar really doesn't necessarily stand for anything, okay? It's sort of like an abstract representation of value. How that value is calculated is basically based on the supply and demand of the dollar, which is why if we increase the money supply, the value of the dollar goes down, okay? But in gold standard, you can't do that, right? Because you have a fixed amount of gold.
There's only X gold in the world.
There's only X amount of gold in the world. So, what do you guys think are the pros and cons of moving to a gold standard, right? Because there are both pros and cons.
This is tough.
I mean, it's a tough question, but it's a nice application of the principles you want to cause. Yeah.
What did you say was fixed again?
So the amount of gold.
So
No, like the
So I
money
say
part.
that
Oh.
that $100 is fixed to equal 1 ounce of gold,
Right.
right? So basically, what that means is that if you bring me $100, I have to give you an ounce of gold. If like I'm the central bank,
Okay.
that's what it means.
So, with that, does that mean you can't play like everything we just learned about the adjusting inflation and unemployment rate? You can't play with all that.
There it is. There
See,
it is. That's genius.
That's terrific. That's exactly right. So what it essentially means is that you no longer have control, right? So you can't print more money because, well, if you could print gold, talk to us because you're going to make us all very rich, right? You can't do any of that. So you might think, well, that doesn't sound like a pro, right? It sounds like a con because all of a sudden, if you're in a recession, you can't just print your way out of it. You can't print a bunch of money and stimulate the economy and lower unemployment rate, right? You can't do that. But what do you think is a pro? Because there is a distinct benefit to moving to the gold standard. So it's not all bad. This is also tricky. So it has to do with
Max. Yeah, Max is getting
Well, wouldn't there be a ton of less money if we went to the gold standard? Since we
Yeah.
can print as much as we want?
Well,
So-
you could like set the exchange rate to be whatever you want
Yeah,
initially, right?
Yeah.
So
Let's assume that
Yeah,
that's not
but
an issue.
over time, I mean, if money accumulates in a few people's hands, it's gonna be a lot less to go around.
okay, so you're getting kind of close. Any other thought? Yeah.
Well, it basically guarantees the value of the dollar's not going to change.
Yeah, exactly.
Exactly, right? So all of a sudden, investor confidence is set, right?
Forever.
It's forever because, people are like, well, you can't screw it up. You can't, all of a sudden, you can't cause inflation to skyrocket because the price is fixed.
Stability,
It's not-
basically.
Yeah, I mean, it's the difference between a floating system, right, where the value of the dollar constantly shuffles up and down based on inflation rates. You saw that graph earlier. And a fixed system where it's just a flat line because it's just tied to a specific amount of gold. So then people become very confident, right? So they think, well, my investment is safe in the U.S. because it's tied to a specific amount of gold. So the upshot is people are more likely to invest in your country.
Yeah. Question.
Who decides that how much of gold is equal to your currency? If you decide yourself, every country is going to want a different rate in order to boost confidence. And what if this depends on how much mineral you have in your country, which is totally not fair?
So,
You guys are asking all the right questions. I love this.
so it was decided after World. So this like really happened, right? So like World War II, or at the end of World War II, the Allies they win, obviously, right? They're trying to see how are we going to fix the global economy, right? So John Maynard Keynes, the guy we talked about over and over again, he proposed this gold standard to set up an international system where gold was pegged to the dollar, and then all the other currencies were pegged to the dollar. And when we say pegged, it means like a fixed rate, right? And because because like the U.S. was the economy at that point, right? It made sense to base everything off the dollar, but then you wanted to have stability into like post-war era, right? So you peg the dollar to gold.
So this would be like saying $1 US equals 1 pound of gold, and
Damn,
like
that'd be
one
good.
European, I know, right? 1 European euro equals like $2 US, right? So everything else gets split in terms of dollars.
So this was going just fine, right? Until basically, I mean, without getting too much into like economic history, basically prices started like rising around the world, and countries were like, hey, we want to control our own, control our own currency. So then like other countries started saying, hey, we're not going to peg our currency to the U.S. anymore. And then Richard Nixon in 1973, right, said, hey, we're not going to peg our currency to gold anymore, and the value of the dollar just went down like in a day, right? So people who like owned the dollar before that just got screwed, right? Because like before, like a dollar was worth like, let's say like half an ounce of gold, and then when you like remove the peg, the value of the dollar just came back to reality, which is what it should have been, which was much lower. But anyways, if you want to read more about that, Alan Mattisau is a professor here in the history department. He actually has written a whole book about this, right? So read the book, talk to him about it. I'm sure he'll go on and on about it.
Yeah. So
Anything else? I don't kept people over, so I mean, as always, feel free to go, but feel free to stay also. Max, question?
Well,
Comment?
countries that stole gold from other countries have to give back the gold that they stole?
Max, you're asking me a very tough question. Two people who have no answer.
Oh, the obvious
Yeah, that-
answer is yes, they will.
that
right?
kind of goes out the scope of
Well,
economics,
yeah,
and more into like warfare.
Yeah, it's like, some So economists don't really care about fairness, right, that much. We just care about efficiency. So we don't care about who stole the coal from who. So tomorrow, Sewell, what room is it? 305? 305 something? Okay, let me figure it
It's
out.
on the event.
Okay, yeah, you guys should all be there. So this is going to be great. Barack Obama. Let's see, where is it? Where is this?
Just say here for.
Oh my god. I think it's Sewell 304
Okay.
or 5. Is it? No, what's that like big room in Sewell? On the
301.
301. 301. It's 301.
301.
We'll be there. You'll see. You'll like hear us like yelling when we cheer for Barack Obama.
Maybe we should come ask this question. Again, this was this was probably our like, most difficult lecture to digest. It'll get easier from here on out. So
Yeah.
I mean, if you have any questions, anything we talked about today, if you want to learn more, we can point you in the right direction. Just come on up.
And there'll be at least one article up after class. Maybe we'll put some more. I gotta figure some out.
If we don't go to this, we'll get watching this meeting and stuff and then
Good question. We'll email out tonight because we can.
Yeah, we understand. Thanks, guys.
Does this count as a towards the board?
Yeah, if you come.
If you come.
For sure, if you come and we'll answer your question. In email. So is there anybody here? Last thing, is there anyone here not on the owl space?
I will.
We'll put everyone on it, because I think we're going to be sending out a lot of stuff on it. I just want to make sure we're on it.
Because the court.
Everyone's on the owl space? Good.
No, I just
Thanks,
want to
guys.
go with that. I said, I